Are you a beginner investor looking to avoid common mistakes in the stock market? Embarking on your investment journey can be exciting, but it's not without its pitfalls. There are common mistakes that beginners often make, from failing to conduct thorough research, to allowing emotions to drive decisions, to overlooking risk tolerance. Understanding these can significantly enhance your chances of success. Today, we will discuss some common pitfalls that you should be aware of as a beginner investor. One of the most common mistakes beginner investors make is not conducting thorough research. Imagine you're about to embark on a journey, but you have no map, no compass, and no idea where you're going. Sounds risky, doesn't it? Well, that's what it's like to invest without doing your homework. Understanding the fundamentals of a company is crucial. You wouldn't buy a house without inspecting it first, right? The same logic applies to buying stocks. You need to look under the hood, examine the company's financial health, its business model, and the industry it operates in. Beware of the dangers of investing based on tips or rumors. It's like following a stranger's directions without checking if they're right. You could end up lost or worse, in a financial pitfall. Investing is not a game of chance, it's a game of skill and knowledge, so arm yourself with information. Remember, investing without proper research is like sailing without a compass. Another pitfall is allowing emotions to drive investment decisions. Now let's dive into that. Fear and greed, they're two powerful emotions that can cloud our judgment. Fear can make us sell at the slightest hint of a downturn, while greed can make us hold on to a stock for too long, hoping for just a bit more gain. Both scenarios can lead to poor investment decisions. It's essential to remember that the stock market is inherently volatile. Prices rise and fall, often unpredictably. Reacting emotionally to these fluctuations can cause us to make hasty, ill-informed decisions. Instead, we need to approach investing strategically. That means doing our homework, understanding the fundamentals of a company, and making informed decisions based on that knowledge. It means setting clear investment goals and sticking to them, even when the market gets a bit bumpy. Remember, investing isn't a sprint, it's a marathon. And to succeed in the stock market, you need to keep your emotions in check. Often, beginner investors overlook their own risk tolerance and fail to diversify their portfolio. Let's unpack this statement. Firstly, risk tolerance is your capacity to endure potential losses without panicking or altering your investment strategy. It's essential to understand your risk tolerance to craft an investment strategy that suits you. Now, let's talk about diversification. Imagine putting all your money into a single stock or sector. If that particular stock or sector crashes, your entire portfolio takes a hit. That's akin to putting all your eggs in one basket. Diversification is a tactic that can help mitigate this risk. By spreading your investments across a variety of asset classes and industries, you can cushion the blow if one sector underperforms. Remember, investing isn't about winning big overnight, but rather about making consistent, calculated decisions that align with your risk tolerance and financial goals. A diversified portfolio and understanding of your risk tolerance are key to managing risk. Short-term focus and ignoring fees are two more common mistakes. Now, let's delve into why. Aiming for quick profits might seem like a smart move, but the stock market's short-term unpredictability can lead to losses. Successful investing typically involves patience and a long-term mindset. It's about planting seeds today for a fruitful harvest tomorrow. On the other hand, ignoring fees can seriously impact your returns. Transaction fees, commissions, and other expenses all nibble away at your profits. And while these fees might seem small individually, they can add up substantially over time. Therefore, it's essential to factor in all costs associated with buying, selling, and maintaining your investments. Remember, investing isn't a sprint to quick riches, it's more of a marathon towards building wealth. The path to successful investing is paved with patience, foresight, and a keen awareness of all associated costs. Always keep a long-term perspective and be aware of any fees associated with your investments. Scene script. Chasing performance, trying to time the market, and overtrading are other pitfalls to avoid. Let's start with chasing performance. This is when the fear of missing out, or FOMO, kicks in, and investors start running after hot stocks or recent high performers. But remember, the market is a fickle beast. Just because a stock has done well in the past doesn't mean it will continue to do so. In fact, studies show that yesterday's winners are often tomorrow's losers. It's best to stick to your investment strategy rather than getting swept up in the excitement of the crowd. Next up is market timing. This is the belief that you can predict the perfect moment to buy or sell stocks. Sounds great, right? But in reality, predicting market movements is nearly impossible. Even the most seasoned investors struggle with this. Instead of trying to time the market, consider a disciplined investment strategy that keeps you invested for the long haul. And finally, overtrading. This is when investors buy and sell stocks excessively, often in response to short-term market fluctuations. Not only can this lead to high transaction costs, but it can also result in a hefty capital gains tax bill. It's important to have a clear strategy and to stick to it, rather than making impulsive trades based on fleeting market trends. Avoid the temptation to chase hot stocks, time the market, or trade excessively. Finally, the last common mistake is investing without a well-defined plan. Imagine setting out on a journey without a map or a destination in mind. The chances of getting lost are high, right? The same applies to investing. Without a clear strategy, the journey to financial growth can quickly become a confusing maze. A well-defined investment plan should outline your financial goals, risk tolerance, and time horizon. It should guide your decision-making, helping you choose the right assets at the right time. More so, a clear plan can serve as a compass during market turbulence, helping you stay on course and not be swayed by fear or panic. Remember, successful investing is not about outsmarting the market or chasing quick profits. It's about consistency, patience, and discipline. It's about making informed decisions based on a solid plan. With these tips in mind, you're now better equipped to navigate the stock market and avoid common beginner mistakes. Stay tuned for our next video where we will dive deeper into each of these common mistakes and provide strategies to avoid them. Don't forget to subscribe and hit the notification bell to stay updated. Happy investing!